I think what you said was pre-revenue,
Yeah.
right?
How about
I
how about
what I
pre-functionality?
yes, exactly. What I also heard was pre-functionality. I also heard pre-forethought.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy.
Boom. I know we're short on time today, so we're gonna just talk it 1.5 times, and then the listeners won't have to speed us up.
What are you talking about, Skippy? What do you do today? Got something in the fishbowl?
So much in this fishbowl. Let me kick off with some admin, right? We reached a major milestone in terms of downloads this week, and it's just appropriate to give some shout outs. So first of all, shout out to all the listeners, but a special shout out to Latvia, where we are the number 2 investing podcast in the entire country.
Why be number 2 when you could be number 1? What does Jack Welch say, baby? Bring it to number one.
Going out on top. Still love the listeners in Guatemala. The Netherlands is hitting us strong. I mean, Germany and France, pretty good. I'm shocked. My peeps in Ireland are not doing what I asked them to do, which is all right. I don't mind. We even got some Australia in here. I love it. So on that topic, just real quick, we are still available for listener mail, skippydoogles@gmail.com, on Twitter, @skippydoogles. Love that stuff. I got a couple more comments this week, but keep those coming. And then the only way we really get discovered with the algorithms is with reviews. So hit us with the 5-star review. I mean, if you're thinking about Doogles and it's only a 4-star review, I guess that's okay. But
no, with Doogles, they want 5.5 stars, baby, but they can't find it.
I see. That's what's going on. Mm-hmm. So, yeah, that's fun. And shout out to the listeners, especially our Latvian crew. We need some listener mail from the Latvian team.
Yeah,
definitely.
Please do.
Anyway, what's up with you, Doogles?
Oh, I don't know what websites you were crawling this week, but I kept coming back to JPM, baby, JP Morgan's website. I spent so much time on JP Morgan's website. It's sad.
I mean, this is one of those statements that, like, none of my other friends, colleagues, acquaintances, that's just uniquely Doogles. Like, no one else gets caught up in the JP Morgan website for the week.
No, yeah, people are getting lost in the clickbait of YouTube, and I'm getting lost in the clickbait of JP Morgan. I see the word assets and I click. But yeah, no, I spent a good amount of time there because Jamie Dimon, the CEO, came out with his letter to shareholders, right? Annual.
Yeah, and he thinks we're gonna be printing money figuratively for till 2023, and everything's gonna be roses, right?
Well, I wasn't even about to dive in, but you now sorry. Yeah, you now Hansel and Gretel'd me. I'm following those breadcrumbs. He thinks the economy is going to be booming for the next 2-3 years, and he thinks inflation may not be a short-term thing, as the Fed has been saying, but could be longer term. That's true. That's not even the stuff I found interesting. I mean, you're bringing up the uninteresting stuff. But
all right, well, hit me with it already.
Do you have anything with the additional hotness in the fishbowl before I get into this?
I mean, I'll update you on my self-coded crypto index, but we can kick that to later in the episode.
Python.
Yeah, that's right.
Yeah, loving it. Cool. Yeah. So the two things, as I stated, Jamie Dimon's letter to shareholders and the JP Morgan's quarterly guide to the markets. So I want to hit on both of those, but I'm gonna start, and then we can follow whatever threads, because there's kind of potentially a lot in here. But so JP Morgan, right, largest bank in the U.S., about $3 trillion in assets. In truth, manages about $30 trillion in assets. So it's huge. And so people kind of follow what Mr. Dimon says just in general to get his take, because they control so much money. And so I'm going to start off with the letter to shareholders. So this thing is, I would tell you to go and read it, but lately I've been recommending so many things that people don't want to read that I'm not going to say that, because it's 66 pages long. But he spends the first 10 pages talking about how great JP Morgan is. basically. It's like all these charts about the greatness of JP Morgan. One chart is called Our Fortress Balance Sheet, which just gives you it gives you the type of tone that he has around.
No, but listen, even that wording, a bubble happens when people get overconfident and think it's super easy to make money. And I don't mean to initially go like straight to a bubble, but like he's bragging about the balance sheet. The last time I saw that happening in banking is when everything exploded and people were going, "Oh no, the way we package these mortgage-backed securities, like they're AA rated." I don't even like that terminology, but I didn't dive into the 66 pages.
I hear you. He kind of like goes back and forth a little bit about saying like, because you mentioned all roses. He's like, JP Morgan's doing really, really well. There are some risks to JP Morgan. There's competition, which is really like competition's a great thing, but the competition is kind of sucky and it's not our fault. Like he kind of goes back and forth with that kind of stuff. But so this 66 page like opus effectively covers its risk to JP Morgan and how great JP Morgan is. Then some like non JP Morgan stuff, like the purpose of a corporation, how to be a great leader. It's like this stuff that's just like you just felt like writing. It talks about COVID, how to keep America great. But the one area that I want to highlight and mainly talk about, because I found it interesting, is he spends about 5 pages talking about the relatively shrinking role of big banks in our financial system. And I thought this was it. This is particularly where he says like, so banks are shrinking on a relative basis. Competition's great, and this is good. However, this is really bad. But the ways in which he talks about this are kind of fascinating. So one is he has this chart that he basically brings up the size of banks from, if you look from 2000 to 2020. And he uses loan size, market capitalization size to show the change in liquid assets. So U.S. banks market cap, to give a couple figures, in 2000, 1.2 trillion. In 2020, 2.2 trillion.
Yeah.
So a little bit less than double during that time.
Yeah.
What he then compares this to, he compares it to a whole list of stuff. But a couple things I'll throw out that he compares it to, which I think is super fascinating, is one, total private direct credit. So if you look at credit getting from private sources, from 7.6 trillion in 2000 to 18.4 trillion in 2020.
Okay.
More than the double. Size of the U.S. passive and ETF market, 6.9 trillion in 2000, 30.8 trillion in 2020. So 4x, let's call it.
What's his parallel to banking with passive ETFs?
Yeah, so he's putting those plus money markets and hedge funds and private equity into this category. I mean, he breaks them out
deposits
separately.
Almost.
Yeah, he calls it shadow banks.
Yeah, okay,
right, which I think is interesting. And hedge funds, 0.6 trillion in 2000, 8 trillion, right, in 2020. So that's like the shadow banking. And I'll throw in one more thing before I put in some commentary. Then he talks about what he calls evolving competitors, which he lumps into payments companies, fintechs companies, and then Google, Amazon, Facebook, and Apple. He breaks that separately.
Yeah.
So looking at market cap, you can't even say what's really interesting. You can't even, in 2000, it just says non-material, right? Because like Facebook didn't exist. Amazon was 4 years old at the time.
Well, and
Apple
if they
was
were
trying
around,
to not be bankrupt.
They didn't have a banking arm.
Yeah,
I mean,
exactly.
Yeah.
But so he says non-material from a market cap perspective. And then 5.6 in 2020. Payments companies, NA to 1.2 trillion. The point basically, he's saying they all now have payments. And so
yeah, of course
what he rides this into, which I think is interesting, is not just the payments part, but what happened after the last financial crisis that Mr. Dimon led JP Morgan through. Dodd-Frank came in. Wait,
I'm just throwing shade. Go.
Well, what is there a different word?
I don't know. I'm not the hugest fan. I'm not the hugest fan, but keep going.
I gotta bring personal vendettas.
Yeah.
I
know. We were in the boardroom together a while back. Did not end well, but
it's all right.
Keep going.
Well, anyway, so after the great financial crisis, right? The GFC. After the great financial crisis, Dodd-Frank came out. There's just more regulation around banks.
Yeah.
And what he's basically saying is, if you're a big bank, so a bank with over $10 billion in assets, you now have liquidity coverage ratios. You now have caps on the amount of money that you can make from debits, but these other companies don't. And I think that whether or not you believe that that's leading to anything, I think that it's interesting to think about. And can I read you 2 quotes and then open it up?
Please. No, I find this so fascinating. This is super interesting stuff. So keep going.
So one thing he was saying that prior to the pandemic, banks had $13 trillion in deposits, but only $10 trillion in outstanding loans, right? Yeah. And that 3 trillion he's calling lost lending. And it's directly related to the liquidity coverage ratio, right? The amount of money that big banks have to hold. Another thing he said, a bank servicing a checking account that spends $20,000 per year only makes $120 in debit revenue, whereas a small bank or non-bank would make $240. Not checking that exact math, obviously, because it's obviously rounded. But his point is like we can't even compete in certain customer segments, whether or not we wanted to, that smaller banks can. And then the creme de la creme, banks are a reliable, less costly, and consistent credit provider throughout good times and bad times, whereas many of the credit providers listed in the chart I was talking about above are not. More important, transactions made by well-controlled, well-supervised, and well-capitalized banks may be less risky to the system than those transactions that are pushed into the shadows.
Yes.
Whenever you end a sentence with "into the shadows," I think you put your cards out there.
No, so he's nailed a lot of this, I think. And as he should, he's probably the most renowned and maybe the most successful banking leader in the world. He's certainly up there. Very interesting. I'm going to have to go back and read those 5 pages. And Doogles, for a non-banker, you just aced that. That was like very well done. Gosh, he's certainly on to something, but it's hard to sympathize with the woe is me stance when you're the largest bank in the US, and basically printing money. But he's on to something. And I hadn't really thought about the shadow banking in terms of additional risk because of the less regulation associated there.
That's the part that really got to me, because in the top of my brain, I'd known that, like, obviously Apple, et cetera, are in payments, and I knew that these organizations existed, but I just hadn't put them in the same realm as a bank. Like, I hadn't really thought about that, right? As like a real bank, as opposed to them having this financial arm such they could help their main business. Like, I'd only thought about it that way, not as it being a bank in and of itself.
Yeah, but like, the downfall of GE was effectively the bank, the financial arm. They got too big, they got too risky, that eventually it eventually drove all the profits in good times, and then it kind of took away significant profits in bad times. So it's not like that's without risk. I don't know. I got to think about this more. I'll tell you that banking has challenges, not only with the regulatory stuff he's talking about, but the fintechs that have now been around for more than 5 years and have a decent user base, and then capitalized on some of the stuff happening in the pandemic, just absolutely are blowing the bank experience away. And I think it's that middle tier that has more concern. I mean, JP Morgan, US Bank, Bank of America, they're not going anywhere. Wells Fargo. But that next tier, I think there will be more consolidation. And I think they're going to just flat out lose customers to the fintechs with people under like 45.
We shall see. Cool.
Yeah, I can't wait to dive in. It's good stuff.
You should. You read like the first page just to get a whiff of the de Percy that he tries to put upon there.
I know his writing style, but I'll give you a page.
Yeah, cool. Before I go into the rest of JP Morgan, let's dive into your Python stuff so we can give the listeners a break.
Well, hey, Doogles, I know you've founded companies in the past. This is old hat to you, and I wouldn't say I've founded a company yet, but welcome to the first edition of the business pitch portion of the Skippy and Doogles podcast. You ready?
Oh wow, okay, hit it.
All right, so I've been talking a while about my fascination with crypto, even though there's basically no money, no real investment there. I still go on the speculation side. I've been talking about how in the U.S., the SEC has been really slow to allow ETFs and other more traditional vehicles. And I've been talking about the desire in a marketplace where you think maybe you have 10 things and 2 or 3 might go up 10 times and 7 might go to 0, how to distribute that holding, right? And so
Yep.
I wrote a little code that effectively allows me to tie into crypto exchange and make regular purchases, whether that's like market cap weighted or equal weight, whatever. And a
Wait,
basic,
so this is an algorithm that'll like buy for you?
yeah. Yep.
Wow.
You build kind of your own custom index within this account with whatever cryptos you're into. Can we take a quick aside? You obviously know about indexing and the advantages, say, in the equity space. Do you know about custom indexing?
Very superficially, but the broad thought. But spit some lyrics on it.
Yeah, I mean, just for the listeners that might find it curious. So the trend now is more, instead of just telling your client to go buy the S&P 500, you might talk to your client and figure out that they'd benefit slightly more from like a value tilt or a momentum tilt, or they, if they're really high net worth, maybe you can get some more tax advantages if you own the individual stocks rather than the index that holds the stocks. So
Yep.
With the way technology is, like, it's really easy to basically build your own custom index. And the O'Shaughnessy shop does this. I think they just reached $2 billion in assets. And anyway, like, this is a thing now, even in equities. And so the question is, why isn't this a thing in crypto? And I'm not even claiming that this strategy is anywhere near that sophisticated.
Hold on.
What?
This is a thing in equities, so like, why isn't it in crypto?
Yeah, come
like
on,
if you
what-
follow
like-
that thread with with many things, that's a
I'm here for your entertainment value. I mean, this is well. So I haven't even told you, right?
Yeah,
So
yeah.
in the sandbox environment, like, this is working, and I can buy crypto in the denomination I want. So I'm pre-seed, pre-revenue, because it only works on my personal computer right now. And Doogles, I'm pretty sure that the appropriate valuation is about 20 Bitcoin for this technology that's going to revolutionize the world.
Okay, hold on. So you said 2 things. I heard 3. I think what you said was pre-revenue,
Yeah.
right?
How about
How
about
what I-
pre-functionality?
Yes, exactly. What I also heard was pre-functionality. I also heard pre-forethought.
Yes. I mean, but you're not laughing. This is, I mean, how serious do you think I am? I think it's pretty
I think
cool
you're pretty
that-
serious. I mean, you brought this on to the #1 investing podcast in Latvia, so I think you're pretty serious. Can you actually go? Can you go like a couple layers deeper though? I want to hear like how it works. A little more detail.
No, so it's pretty simple. I mean, basically the user experience, like, I haven't built a website yet, and I don't even know if I will until the Twitter blows up with potential investors, right? But I thought this is an interesting, as you know, I think this is an interesting space. I thought this is an interesting technology tying in with the APIs. And so the fact that you can do it is just fascinating. So I will probably throw a few bucks at this. Again, like, way less than 1% of my invested capital. Like, this is more fun than anything else. Just because I think that, like, building your custom crypto index fund is interesting challenge at the moment. And I told you before, I told you 6 episodes back, when you're going, why do you keep talking about crypto? You're a value investor. Like, this is not a value investment. I completely agree. I still feel like this is U.S. equities in 1903. Like, there's so much being built and developed here. That's just a fascinating space. So, and then on top of that, it's U.S. equities in 1903 with, like, computers in your hand and APIs and fancy code to tie together and automate whatever you want. So it's a fascinating challenge. Now, Doogles, you can use this technology for Robinhood, for Fidelity, for anything. I mean, the Plaid APIs can connect you into any bank. This is how all the fintechs build their stuff, basically. and I'm just using similar technology to mess around on my side. But yeah, I know you're going to talk about valuation. I do think 20 Bitcoins is probably, where we need to be right now.
I just want to use some of your words, a false narrative you need to tell yourself to keep yourself calm. No, I think it's pretty cool. I think it's cool you're diving into it. I want to stay updated on it.
Oh man.
Okay, can I get buck wild crazy for a second?
Please.
I wasn't even going to bring this up today, but I could not sleep the other night. And
Chamath?
I don't even know what that is in relation to, but sure. I could not sleep the other night. And so what does one do when they can't sleep?
Either look at your phone, probably read. I probably read.
Okay. Both of those things happened. And there was some video watching. Okay. But what did I pick up my phone to read and watch videos about?
Man, I don't know.
Okay.
Like you had Good Will Hunting on the screen and
okay, so somehow hold on. Somehow you like broke into my mentals partially. Do you know why? Because I watched approximately 2.5 hours or read approximately 2.5 hours worth of Matt Damon.
Ooh.
However, it was not Good Will. I don't even know how you jumped to Good Will Hunting, but it was not actually a movie. It was not any sort of TV show or anything. I read and watched Matt Damon talking about water. And
oh yeah.
Yeah. So the reason why I'm bringing it up actually, and why it's been clicking and why I want to dive in deeply is one, water is a situation of its own. We talked about Burry before, right? Yeah. Burry has been invested in water, but in particular, something that clicked for me, and I'd like for you to think about this too. And if people out there that are listening have thoughts around this, I think that there's a connection between some of the stuff that Matt Damon's trying to do and to make water an investment, and what we've been talking about microtransactions and using crypto to transfer to other places. Yes. I think that there's a connection in order to do that. And part of what I think might be the missing ingredient is simply giving money, I think, to people. It's hard both from the receiving end and from the giving end to figure out exactly what the use case I think it's a being, or why you'd ask or why you give. But water, I think, is a thing that's very tangible, people don't have access to, and takes a little bit to make a big difference in some places. Like the stuff that I was reading and watching about is how many times like you have to like walk or travel many, many miles in order to get your water because you can't afford to tap into the local system.
Yeah.
And it takes like one down payment to tap into your local system, which then unlocks many, many things, including like the amount of time that you can spend on work, which increases the amount of wages that you can get, which changes your entire family lifestyle. And so I just started thinking on this path, are there microtransactions via crypto that can be made in order to unlock water sources for people around the world? So 2.5 hours from about 1:30 a.m. to 4 a.m., this occupied my brain. I fell asleep and I haven't gone back in more deeply, but I'm going to drop that right quick with you.
I love where you're going. So one, it ties together a bunch of conversations we've been having with extreme poverty, right? A lot of times, the reason you might live on less than $10 a day is because you have to walk 3 hours each day to go get fresh water. And so there's a micro lending component potentially, which is just, you find a way to give that community the outlay to get the water that's closer to them. And that completely changes their life. And I like your idea around giving. Not only, I mentioned givecrypto.org, a couple weeks ago. There's another website called givedirectly.org, which is worth checking out for the listeners. I've been doing some research on that. But I mean, I think that almost is more eloquent, right? If I am like, Doogles, I want to give you $100, it seems kind of clunky and weird. If I'm like, me and Doogles and our community want to give this community water, like the price, we wouldn't, I don't really care the price. Like that is such a tangible, life-changing thing that it feels like, wow.
There's something in that. And what it looked like Senor Damon was doing, more, I'd say like a larger water investment strategy with like bigger dollars. Yeah. And it just feel that might do its thing, right? It seems like that thing might be working too, but it seems like there's an unlock in the smaller micro, potentially crypto, because of how easily and inexpensively, right, you can transition. I think there's something there. Listeners, please look into it. Give us your thoughts. And I'd love, Skippy, if you want to dive in, I want to spend a little bit more time there too, because I think there's something real.
Can I hit one more thing and then we'll tie up?
You dive into your fishbowl.
So I frequently rant about how everybody studies excellence and claims like there's no luck involved and blah, blah, blah. You just go do what Jeff Bezos does and you will be the richest man in the world and you'll have the next Amazon. And I just don't think it works that way. I think there's 10,000 people that did what Bezos did and didn't end up with the same results. So there's apparently a pretty popular book here, In Search of Excellence, the 1982 bestseller by Tom Peters, right? I might check this book out. It made all the rounds in the 80s and was hot.
McKinsey, right? my McKinsey boys.
Yeah, your McKinsey boys. So this story comes from The Acquirer's Multiple, which I read last week and was telling you about, right? And what they started doing, not only did there be like business workshops around how these 43 companies became like the premier companies in the world, and it was the new management vogue and everything else. Well, someone smart looked at the stock market performance of those companies for like the next 20, 30 years and went, oh crap, like these things took a freaking nosedive, fell off a cliff, mean reverted down. So basically, this hypothesis is they mean reverted away in the profit cycle. They're making more profits than anyone else, which brings more competition, and that competition eventually brings their profits back down. Here's what happens if you would have invested $10,000 in those companies in 1974.
What? So this is before the book, you're saying? If you'd invested in the
I believe the book studied the 10 years leading up to 1982, so I think that's why this graph starts at 74. And this actually goes through 2013 because it's a updated analysis, right? So you put $10,000 into these 43 companies that are studied in Search of Excellence. They're worth about $400K in 2013. If you just put it into the stock market, that would be worth about $500K. And then because this is a value book, someone did a twist and basically came up with some unexcellent companies, which were almost the least profitable companies in the space that had really tough performance.
And this is in 1974, least profitable?
Yeah, in 1974. That investment of the so-called unexcellent companies worth $1.5 million. So tripled the S&P and obviously destroyed the excellent companies.
Can you give like another level of detail on this? Because what you can't be saying, and if you are, then shut down shop here. You can't be saying if you go to 1974 and invest in the least profitable companies, you will be 3x the overall market over the next.
So hold on. Next episode I'll bring back. This is an updated study by Barry Bannister on. It's called In Search of Unexcellence, and it's an endorsement for value style investing. So there's the real details. I don't have those in front of me right now.
Is this a story in The Acquirer's Multiple, or is this a separate report? Okay,
in The Acquirer's Multiple.
How about this? How about this? Ding ding ding. I'm gonna throw the boxing gloves off, right? Because we're gonna get real deal Holyfield. I'm gonna read this book this week.
Yeah,
and next week we'll go toe to toe around your nonsense.
Come on back.
Is that fair?
I like it. Yeah.
Is that fair? Okay, because I can't have you bringing this onto the show without some defense on my end.
No, it's not so generally I might come across too strong. Generally, value investing and a lot of the argument in that specific book, because that's a deep value investing book, is simply mean reversion is a powerful force. And the point I'm trying to make, which I might be out over my skis with my misleading numbers here, is
you forgot to put your skis on, my friend.
It's simply that mean reversion works, and I'm buying stuff at the bottom of the cycle. Books like In Search of Excellence are claiming that companies at the top of the world, at the top of their profit cycle, are going to do that forever. And that very rarely happens. There's an occasional company that has above average profits for an extended period of time. But most of the time, when you have above average profits, more competitors flood your space and you lose market share to some of those competitors and you go back towards average profits. That's just what happens. That's just like economics.
I'll give you some of that, but next week let's go real deal Holyfield. What I think is interesting from a business context around this kind of thing is going into Clayton Christensen and the innovator's dilemma. Because I think that's the underlying force. Whereas if you take, so have you heard of Jeff Bezos going out on top? If you take someone like Bezos and Amazon, well, one, no profits, but I think if you even put profits aside, when they were, when you go back 20 years, it's really about redefining what your space is. I think in a lot of, and then challenging yourself and breaking your own dimensions down, I think is the way that you can last for a while. Amazon's only been around 25 years, so I wouldn't even say that that's like a long period of time. They've only been dominating for the last 15. But I think it's like they've redefined who they are. They're not who they were 20 years ago. And so when you get so big that you're trying to protect your space, then that becomes really dangerous because other people will do it differently, do it better, etc.
But of course that happens. I mean, if you are that successful for an extended period of time, you get to the point where you're simply too big. And then you become, it's less about innovating and it's more about protecting your legacy market share. And that's a different game. And that's a nearly impossible game to win. It's almost like if you're playing Risk and you decide that you want to like have a land war in Asia, it's a losing battle. You get too big. Go
Princess
get
Bride?
Australia, lock it down. What?
Princess? Are you bringing Princess Bride quotes?
No. Is that from The Princess Bride?
Yeah,
That's just how it rolls. I'm pretty sure that's like a Mallrat quote, if it's a quote at all. Hartford,
anyway.
the whale? Okay.
Anyway, all right. Let's can we fishbowl it for the guide to the markets?
Yeah, you're so disgusted with me right now. I love this.
No,
you started
I'm
off all
actually
happy, and now you're
I'm
like,
not.
we have to talk.
I want to read this book because I want to
Well,
come
you
at
could
it.
just read the value investing article too.
Why read an article when you could read a book?
Yeah, good point. Good point.
There you go. Why read a book when you watch a movie? Cheekbones. So JP Morgan comes out with this quarterly guide to the markets, which is a whole bunch of charts, basically.
Yep. Good stuff.
I like to look through them because I think there's some things that are interesting. This one I think is kind of fascinating. Not so much in a like a new insights kind of way, I would say, but it's like it captures so much of what we've talked about even on here over the last few weeks. And so I think it's worth a flip through for those that want to take a look, because it's like a great summary of many things that are going on right now, broader than the last quarter, much broader than the last quarter, like looking over the last 30, 40 years, to be honest, in some cases. So I'm going to do like a real quick hit, because again, there's nothing necessarily new or fully insightful, but I think it captures some elements real. So you good if I just bullet down?
We should probably throw a couple of these graphs on the Twitter, because that way they can have some material as they listen through.
That sounds good. And interrupt me, hop in if you hear some ignorance. I'm going to drop some page numbers too, so people can find it.
Yeah.
So one is we're doomed for poor returns in the coming years, right? Page 6. Another is this big rotation, and it mentions it compares like some historical returns to the returns over the last year for energy, airlines, REITs, hotels, banks on page 15. I think that's like a really interesting and clear way to show that. Page 17 has annual returns. And
sorry, I got to interrupt. Page 6 is one of my favorite charts. It breaks down sources of earnings per share growth, and it's awesome to see like where it comes from and how it's evolving. So back to page 17.
Oh, so yeah, page 17 is what we talked about recently over the past couple of weeks. annual returns for the S&P 500 and their intra-year drawdowns for that year,
Yeah.
going back to 1980. I think it's so interesting, this one, and highlights, I think 1980 itself is like a really interesting year. It had a huge drawdown.
No, so 1980, 26% return, but the drawdown was negative 17%.
Yeah, it's awesome. So we covered that last couple of years. Inequality, it covers on pages 24 and 25. What you'll love, because I know you're loading up like Scrooge McDuck or Huey, Dewey, and Louie, is on page 57. It looks at international valuation discount relative to the U.S. And shows that right now we're at a PE, a price to earnings discount, at a little bit over negative 25%, right, for international valuations versus U.S. valuations, which is the lowest in the last 20 years. Around page 66, because there are a few of these pages, it goes into the rise of China, talks about like Chinese consumers.
Oh, yeah. Hey, hold on. Page 56. I frequently say we're talking about this because it's interesting and I don't have real money on the line here. I have real money on the line with international stocks. I
told you, Huey, Dewey, Louie.
Yeah. In my 401k where my investment options are limited, I have the majority of my holdings in international stocks. So that's a real thing for what it's worth.
And so page 56, to clarify which one you're talking about, this looks at basically the rotation between U.S. equities and international equities and how they've traded off and on every roughly 5 years, except the last 13 years have been dominated by the U.S. And Skippy saying, I'm betting my entire family's future upon that turning around, where he's previously said negative momentum's hard to flip. So I don't know how those two things go hand in hand, but I love it.
First of all, I didn't say my entire family future. I have some diversification. I'm not a total idiot, but the smart money is on that flipping. So thanks, Doogles.
And then so the rise of China. And then one thing that we've hit on before, which is on page 80, the average investor relative to other performance over the last 20 years. So I'm gonna hit on in order of annualized returns by asset class between 1999 and 2019. I'm actually gonna drop some lyrics here. So between that time period, that 20-year time period, number one, according to this JP Morgan chart, is REITs with 11.6% per year. High yield was 7.9% a year. Small cap 7.6% a year. Emerging markets equity 7% a year. S&P 500 6.1% a year. A 60-40 stock bonds portfolio 5.6% a year. A 40-60 stock bonds portfolio 5.4% a year. Bonds 5%. Developed markets equity 3.8% per year. Homes 3.4% a year. The average investor 2.5% a year. I think that's probably based off of the Dalbar study, so you can do what you will with that, Skippy.
I'm going for the footnotes right here to confirm.
Inflation 2.2% a year, cash 1.7% a year, and commodities 1% a year. So that's 1999 to 2019. I think interesting when you look at that in the highlight portion, looking at where the S&P 500, the market sits, and average investor far down that list.
It is the Dalbar information, so take it with a grain of salt. But also, I mean, some of that stuff like homes. I mean, read the footnote on homes. The home markets are so different. Like, let's just talk about Detroit home prices the last 20 years versus let's go San Francisco home prices the last 20 years. It's tough to just throw that into a category and call it home.
Sure, but you can say that. You say
I'm
the
not
same
trying
thing
to
with
be
the
nitpicky.
market. You can say the same thing with the market, right? Like the S&P 500 is so different. Like look at
that's
technology stocks versus bank stocks.
Whoa, Doogles made a good point. Nice work. I like it. You're gonna throw something at me.
How can I? I need a pandemic adjusted way to come over there and set you straight. Fishbowl.
Yeah.
You got anything?
No, I'm done.
All right. I'll drop one last thing. Maybe we could spend 5 minutes. You cool?
Yeah.
Okay. So we talked about Biden's infrastructure plan last time, right? And we mentioned,
is this a Biden thing? Because, dude, you know how I talked about my fatigue last time? He did 2 trillion coronavirus release. Then he did 2 trillion infrastructure. And then his real budget came out at 1.5 trillion. I'm like, dude, I'm ready to pass out from these large numbers that you keep. Like, just stop saying things and start with trillion. Like, do something that's like, anyway, that's my mini rant.
Biden fatigue.
Yeah, I'm so over it.
Love it.
Gosh.
It's been 2.5 months. So I'm just going to mention the infrastructure bill. So calm down, right? Calm down a little bit. So I'm just going to mention it for a second. When we were talking about that last week, we dropped like one little line that said that was around how he's going to pay for it, to say he wants to increase taxes, right?
Yeah.
What I want to say here is that because we mentioned the tax rate, the domestic tax rate, I'll call it. So rising partially from what Trump brought the corporate tax rate from 35% to 21%. Part of what Biden was saying was increase the tax rate from 21% to 28%, and then increase taxes for people over 400K. So that's what we mentioned last time. What we did not mention, and Yellen started talking about this week, a few days ago, was increasing the corporate tax rate for multinationals on what they're doing overseas. And she's effectively saying, let's create a global minimum tax. Thoughts?
I know a lot of smart business people in Europe, and I've been on some tech chains this week. Different countries have used lower tax rates as an advantage to recruit American multinationals, but even non-American multinationals. And America has a lot of advantages in this world, right? American colonialism, American capitalism. I mean, there's flaws, but there's a lot of advantages with the current situation we sit in. But I think it's a conversation that is worth having, certainly, because it would make things significantly more. It feels like things would be more on a level playing field, and there are some benefits to that.
Yeah. So this, I'll give a very brief opinion, but to go into a bit of the mechanics too of how this would work is basically what we're saying, we being the US, are saying or proposing is that there would be a 21% like minimum tax on US corporations. And the way that would happen is if a different country had a 10% tax rate, that you'd have to pay that difference, right? To pay the 11% back to us. My very brief opinion, I would say, is that this is a situation where, quote unquote, leveling the playing field is actually just giving the US an even bigger advantage because we're systematically advantaged otherwise. I mean, and look, as a US citizen, I would be like, yeah, let's do it. As a global citizen, I think it's kind of like I think it's going to end up with some shoddy results, is what I would say. It's anti-competitive, I think, in nature.
First of all, there's always a loophole. So that will be found. But so like Ireland is a classic example. Tax rate, 10%, might be 12.5 now.
Yeah, Ireland's like the entry point to the Europe, basically.
Right. So if this goes through, why doesn't Ireland just raise their tax rate from 10-ish to like 17 and keep more of that money there? Because if Apple's in Ireland and they have to pay 21% minimum, Apple doesn't care if they pay that to the Irish government or the US government, right?
Yeah, they just don't want to pay it.
So, but so they're stuck paying it, and Ireland's going to be like, you already have operations here. We're raising our tax rate. We're stealing more of that money from the US government for the Irish government. Like, there's that loophole that I don't know how Yellen addresses. Sorry, the hypothetical, I thought she was proposing even more than that, was like, let's get together across multinational lines and try and come up with a minimum tax rate, rather than let's steal U.S. taxes on top of whatever the other country's tax rate is to get back to that 21%. That's an interesting.
Yeah. So I conflated a couple different things, because you're right. So what Yellen specifically this week said was we want to get the G20 together, like the top 20, quote unquote, top 20 nations, right? Yeah. And create I'm not going to use the word cartel, but I just did, but create a global minimum tax rate. What I was linking to the Biden infrastructure plan is what he was saying as part of the plan was to do this. Regardless, it's basically in both cases, it's how do we put the U.S. in a better competitive situation relative to other countries that have lower tax rates, such that we can recoup tax dollars. I mean, that's basically what however you do it, the mechanics of it. That's what we're after.
Well, the first one though, the first one's a little more interesting. You get the G20 together, and let's assume that other countries follow. If the G20 also says the global minimum tax rate on corporations is 20%, I think I see some merits there, because like this is not, we don't live in a manufacturing-based economy anymore. It's not like when you have operations in the US and Mexico and Canada, it's because you're mining there. It's a lot of people sitting around with laptops, right? And so it feels like it's much easier to shift operations artificially in a way to pay lower tax rates in some locale, in Ireland, right? Without really doing a meaningful investment in that space. And that's just people playing a tax game. If there's a global minimum tax, I think some of that could be avoided, and you'd actually pay more taxes where your true talent is, which probably has some benefits to the world economy.
Maybe. I think this takes away potentially some legs to stand on for countries where, I'll just call it a price, right, to keep it simple, can be an advantage for them. And makes it where we're saying basically, if you just put this in, let's act like the US is a corporation, and we basically say, like, we know that price won't be an advantage for us, so therefore let's make sure that price can't be an advantage for other places. Like that's right.
Sorry to interrupt.
Now, again, as an American, I'd like to get better bridges. I'd like to get better roads. I'd like to get better toll booths. I don't think he's trying to fund toll booths. I don't know where that came from, but you know what I mean? But I think from an international, like if I take away like the citizenship like part of it and like where I live, I think intellectually, academically, it's an interesting exercise to kind of talk through. But
I'm generally a free market guy, so that's probably right. But there's a lot of interesting dynamics going on here.
There are. Cool, man.
All right.
Good combo.
I think my concrete guys are here, so I got to go.
All right. I got to go play soccer.
Perfect
Be
time.
my child.